Hello, and welcome to today's panel discussion titled Pressing Opportunities in Fixed Income. I'm Phil Gioia, and I'll be your moderator today. And the goal today is really to give investors ideas about portfolio construction as we head into 2024. To do that, I'm joined by three very distinguished portfolio managers here at DoubleLine. First, we have Ken Shinoda. Ken is the chairman of DoubleLine's Structured Products Committee and the head of our non-agency residential mortgage team. Robert Cohen is the director of DoubleLine's Global Developed Credit Group, which covers U.S. investment grade and high yield corporate bonds, as well as leveraged loans and collateralized loan obligations. And finally, Chen. Morris is the head of DoubleLine's commercial real estate team, which oversees all commercial real estate and CMBS related investments here at the firm. Gentlemen, thank you for being here today.
Thanks, Phil.
Thank you.
Thanks, Phil.
So rewinding the clock a bit and thinking back to 2022, right, it was the third worst year on record for the traditional 60-40 portfolio. That mix of stocks and bonds was down a little over 18%. So coming into 2023, many investors were looking for or were hopeful of a rebound. And we've seen that to some extent in equities, right, particularly the growthier tech names. But fixed income, it's been more of a mixed bag. You've had parts of the market that have done extremely well, right, Robert, things like floating rate bank loans, CLOs, riskier credit. You've had more of the traditional parts of the market like treasuries and agency mortgages. They're flat to slightly negative. And then Morris, not to pick on your sector right at the beginning, but, and we'll certainly talk about the risks of, overgeneralizing the CMBS market, but at least some of the index data that we look at, it appears that the, lower rated CMBS have been the laggards this year. So a lot of dispersion, right? So Ken, maybe you could help set the stage for our viewers and, talk about what's driving that dispersion across fixed income, kind of where we sit today.
Sure. So we have a slide here that's the year-to-date returns through November 8th, and it's probably the complete opposite of what everyone thought at the beginning of the year. Recession imminent, treasury yields falling, credit spreads blowing out, stocks doing poorly, which, by the way, most of them have outside of those big seven mega cap tech names. And it's been the quite opposite. High-quality fixed income has done poorly because rates have risen. We started the year around 380 on the 10-year. We got all the way up to 5. We had a pretty good rally. Today's auction's not going so well, so we're selling back off here. But broadly speaking, risky and floating rate has definitely been the place to be. Some of the securitized sectors haven't done that bad relative to longer duration corporates just because they're shorter duration. So it's really kind of higher quality, longer duration parts of the market like treasuries and agency mortgages and corporates that are the laggards, if you will. And really agency mortgages, and we'll touch on that. But treasury yields have gone to basically decade-long highs. More than that, I think we're like 15, 16-year highs. So if you've been short duration in your portfolio, I think it's time to take a victory lap and start taking a look at it because we do see signs of slowing economic growth. We do see signs of slowing inflation. Last week was finally, after it seemed like months and months of only positive economic news, which is obviously bad for bonds, we saw some of that negative or slowing economic news come in. We had manufacturing PMI at 46, which is contractionary. Services PMI dipped down to 51, still positive over 50, but the trend coming lower. And then some of the jobs data coming in softer. So to the extent you've been short duration, we think some value is there in the longer end of the curve. You don't have to buy the long bond. You don't have to buy the 10-year. So you can buy 5-year treasuries. You can just going out the curve a little bit generically in your fixed income portfolios, getting out of those T-bills that we've all been sitting in. We think is a good idea, and we're going to talk about that. As we look back over 10 years, we're sitting at close to 10-year highs across all of fixed income. We're biased because we're fixed income managers, but it hasn't looked this good for us in over 10 years. Because rates were so low, we were living in financial repression with QE and whatnot. So we're going to talk about opportunities across all of fixed income, but that's just to set the stage. The other thing that I think that has prevented people from moving out of T-bills and coming out the curve is just negative returns. You just keep seeing negative returns, and like, when is this going to work? I buy these bonds, I keep losing money, and what you got to really think about is the future, right? You got to look. The past is the past. The future is kind of what's to come. And this is a great slide that we like showing investors. And if you're an advisor or RIA, or even an institutional investor talking to your board, I think this is really a helpful tool. This just takes the yield of the index and it does a simple scenario analysis up and down 100 basis points for yields. Basically, what if rates rise another 100 basis points, which we think is unlikely in the near term, and your return is going to be barely negative. And the reason it's going to be barely negative is that you finally have some yield out there. The yield on the index, when we put this together, November 8th was 530. It got all the way up to about 570 a few weeks ago when we saw higher yields, but it was at 1% in 2020. I mean, it was just miserable. One yield, a long duration. There was no hope for returns then. And of course, with this big rate rise, we've seen really bad backward-looking returns, especially last year. But even this year, even though rates have risen, the return for the first 100 basis points of rate rising was much better than last year. It was about -3% this year. Last year was about -8. But let's just look at where yields are across the high-quality parts of fixed income. I mean, you got 6-7% type yield basically everywhere in investment grade. And when I say investment grade, I'm not even including triple Bs on this chart. That is long-run global equity returns, right? And we think it's a great opportunity to decrease equity risk, to add some stable fixed income cash flows into your portfolio. Now, some of these assets, like single A, CMBS, you'll note the yield is 12. Obviously, the market doesn't think it's a single A anymore. Morris will talk about that in a little bit. But I'd like to say there's something for everyone. If you don't want duration, don't buy it. There's plenty of low duration funds out there, right? If you want a little bit of both, you can get that intermediate fund. If you want credit risk, there's plenty of ways to get, credit risk in a reasonable way that I think, and I'm sure Robert will agree, will do better than equities if you see a downturn. Now, if you want to take credit risk, you don't even get just equity-like returns. You're getting private equity-like returns in pockets of fixed income. I mean, there's teens, there's mid-teens. This is the type of stuff that you were getting and people were locking their money up for in the private debt markets, going into these 5-7 year locked up funds, maybe interval funds. You don't even need to do that anymore. You can get more than equity-like returns in parts of fixed income. It's not without risk, but a prudent bond manager can pick and select names, and we do believe it's really a bond picker's market where you got to try to manage your risk through security selection. But just tons of opportunities out there. And it seems everyone's just afraid because we've seen negative returns, and T-bills have been great, but T-bills will not be 5.5 forever and ever and ever. So it's time to kind of start stepping out the curve.
And Ken, maybe just getting back to spreads for a little bit. So you talked about spreads generally in for most indexes. There are some parts of the market, right, like agencies and non-agency CMBS, where we have seen some widening. So what's been kind of driving that market wider?
Sure. Well, this is a chart we put out. You can get it on our website, and Phil and team on our product specialist team put a great chart pack together that I think it's great to look at monthly. And this is one of our favorite slides. If I walk into a meeting, usually this is the one slide I would use if you only gave me one. And this basically takes all these different spread sectors, and unfortunately, we can't put more on here because it'll start looking too weird on one page. But we try to capture the market. And the higher the dot is on this chart, the cheaper it is relative to its own spread history. So we'll just look at agency MBS, for example, because it's at the very top there. That is 96th percentile today, meaning the spread has only been wider 4% of the trading days over the last 10 years. AAA CMBS is up there. IG has definitely gotten cheaper recently. Now it's about 60th percentile. That was sub 50 maybe 2 months ago. So we look at this basically to give ourselves an understanding on kind of where spreads are relative to history. It doesn't always mean it's a great buy. For example, in the top right, BBB CMBS is also very high up on a percentile basis, but maybe there's risk there associated with commercial real estate. There's a reason the spread is so wide for a BBB that's arguably investment grade. Morris is going to tell you why maybe it's not investment grade. So it doesn't necessarily mean that one asset class is better. For example, the reason IG is down there at 60th percentile means it's done better than these other sectors, as has high yield. High yield and IG have been two of the best performing sectors from a spread standpoint, meaning their spreads have come in. Duration has hurt investment grade, whereas high yield doesn't have as much duration. So we have this available on a monthly basis. We highly recommend you take a look, and you can visit our website to get access to that.
Yeah, so Ken, you mentioned this is your favorite slide. Cohen, as director of our corporate team, and Ken talked about some of the reasons why corporates are a little bit lower on the page here, but curious your thoughts. What do you say to people who say that corporate bonds don't look as attractive to parts of the securitized market?
Yeah, I think you have to look at the composition of the asset classes. We have some more slides if we want to get into it. Start with investment grade. The quality of investment grade corporates now is better than it's been for a substantial amount of time. You could even maybe say over the last 10 years. From one perspective, you look at duration. So the yield per unit of duration, something we track a lot at DoubleLine. Mm-hmm. We'd like to have yield of it per unit of duration around 1. Well, investment grade has been closer to 0.2. It's had, at its worst point in 2021, a yield inside 2% and a duration of almost 8. And so a 1% move in rates wiped out, 4 years of yield. Mm-hmm. So just that one metric set investment grade up for, the symmetry of returns was very much skewed negative. Ken, a few slides ago, was showing about how the Barclays Agg has this incredibly positive skew where rates are down, you probably have around a 0 return, but you have this potential for a double digit if yields go down. Investment grade for the last 10 years have been the exact opposite. You had not much further to go in terms of rates and spreads, in terms of generating a positive return, but lots of downside if rates moved up, and that's what we experienced in 2022. It's also important when you talk about corporate credit, what have borrowers been doing for the last decade? Rates went to 0. The investment grade credit market was effectively using nearly free money to buy their stock. So they were increasing leverage. There was effectively no material cost for going down from AAA, AA, single A, triple B. So borrowers didn't worry about their credit rating. They used that incredibly cheap dollars to buy their stock, finance dividends, and to basically increase the leverage or decrease the credit quality of their portfolio or of their balance sheet. So that deterioration of credit quality along with ultra tight yields and spreads meant that corporate credit had basically nowhere to go. We had a pandemic that caused credit spreads to blow out, and then we had inflation where rates started to rise. So we had this multiple year period where bad things were happening to corporate credit. Well, you come into this year, corporate borrowers realize that they need to be better stewards of the balance sheet. Maybe not because of, they're doing just out of moral desire, but it's a matter of yields, right? Instead of borrowing at 2%, they're borrowing at 6% plus. It's not free money anymore. There's a cost to borrowing. So the corporate credit market is no longer using the fixed income markets to buy back their stocks and fuel dividends. If anything, they're actually defending their balance sheets and paying down debt. And you see that on the slide here where we've had, I think this is a Barclays number in the upper right. We have actually, this is the largest year of BBB upgrades on record. So the BBB cohort, which is the riskiest part of the investment grade market, is improving its credit quality and marching towards single A and double A. So in an environment where you have a better yield per unit of duration and you have better credit quality, you have a setup where you have a lot of things working in your favor instead of a lot of things working against you. And so that's part of the reason why spreads are where they are. Spreads are not just a reflection of where we are, but where the market thinks things are going. And so if you have a company or an index where the borrowers are trying to improve credit quality and you have a decent yield and the economic outlook is, I guess we can say we're not sure, but we're not sure we're going to recession. We're not sure if we're going to continue with economic growth. I think the spreads in slightly above average sort of reflect the fact that you have borrowers defending their balance sheet at a time when there's economic uncertainty that sort of offsets itself. So it doesn't seem crazy that spreads are where they are. I'd also point out that a lot of what drives spreads are flows. So in an environment where people are actively investing in the investment grade market because they're getting yields they couldn't get before, and there's a large universe of buyers who not only buy investment grade credit every day, but are also crossover buyers. It's creating a supply demand dynamic that's very positive. you contrast that with other parts of the fixed income market, particularly securitized, there's a buyer base that has disappeared, and so we need a replacement buyer for spreads to tighten again. So there's different dynamics happening in these markets, and I think that's contributing to some of the spread differentials you see.
Yeah, Phil, you brought it up. I mean, I think one of the reasons, going back to the spread slide, where you see the securitized sector is a little bit higher up, I think it really has to do, as Robert mentioned, with the buyer base. It's not most of it's not in the index. CLOs are in the index. There's no non-agencies in there. 2/3 of the CMBS universe is in the index. And so the buyer base is largely active managers and specialized funds and ETFs that participate in these sectors, and they're just not getting flows. And last year they got outflows. So a lot of the spread widening last year, especially in the fourth quarter, was when money started looking at corporate bonds because they yielded 6 again, but everyone was doing tax loss selling out of mutual funds. So I think when money comes back broadly back into the bond fund universe, some of this cheapness relative to corporates should probably normalize back to kind of historical levels.
Mm-hmm. Yeah, and Robert, you talked about investment grade, and there's an article in Bloomberg this week where I think the title was DoubleLine is overweight blue chip debt for the first time in a decade. So I'm sure a lot of what you talked about is kind of driving some of the moves that we've done across portfolios here, looking at investment grade corporates.
Yeah, it's all the themes we just talked about: better yield per unit of duration, better credit quality in terms of we're in an upgrade cycle, borrower behavior. You also, the risk of big spread moves in investment grade are tied to downgrade waves. So during the pandemic, we had shut the economy down, and we had a large number of downgrades. That creates pressure because investment grade managers need to sell those bonds. Some by mandate can't hold double B. So if a bond goes from triple B to double B, they need to sell it. Mm-hmm. That creates a lot of pressure. At the moment, the universe of credits that are on watch for downgrade is pretty small, and they're actually credits that aren't at risk of jumping past high yield into default. So you put that all together, it's just a completely different outlook for investment grade credit given all the things we just talked about, and that's why we like it now.
So it sounds like a rosier outlook for investment grade. What about below investment grade, right? What about the high yield or bank loans?
High yield and bank loans are sort of the mirror image. People talk a lot about why high yield spreads are so tight. I think one of the key reasons why is because the credit quality is as best it's ever been. Now, we can always argue about valuations, but unambiguously, the quality has been improving over some time. Simple metric to look at is the double B cohort. Double Bs are now about half of the high yield index. They used to be something like mid 30% of the high yield index. Another factor is secured debt. So high yield is typically unsecured and subordinated. That's high yield over its history. Over the last few years, the high yield market has been doing senior bonds, so first in the capital structure, and secured. So that means you're first in right of repayment and secured against assets. Those bonds are less risky, and they should have tighter spreads. So the composition of high yield has changed just from a rating and security point of view, but also the types of credits that are in the high yield market have changed. I mean, you have household names like American Airlines, SiriusXM Radio, Marriott Hotels. We can argue about the credit quality, but they're not the small little $100 million revenue company that it sort of dominated high yield at maybe 10, 15, 20 years ago. It's now more kind of name brand, larger scale companies that deserve lower spreads because they have bigger scale. They are often leaders in their industry. They have competitive moats. They have stronger balance sheets, and so they deserve lower spreads. There's also another element that high yield supply has been dropping over time, and a lot of times spreads are just the result of technical pressures one way or the other, which we've been talking about in securitized, how an absence of buyers is creating sort of spread widening. Mm-hmm. High yield, because it's not a facet of lack of buyers, it's a lack of supply. So because there hasn't been much in the way of new issue, the market has effectively been shrinking. Now, where have all of these bonds gone? If the high yield market is shrinking, where is it going? Well, it's been going to the floating rate market. Over the last several years, borrowers have looked to the bank loan market because of the demand for floating rate paper, which has worked very well. So the floating rate trade has worked, but it came at the cost of rising stress in the floating rate markets. So the riskier high yield bonds that needed to get refinanced were refinanced in the bank loan market. And what that did is it took the tail risk, the riskiest credits, out of high yield, and it moved them to bank loans. And you can see that just looking at ratings by the deterioration or the migration of the single B credits. So single Bs have increased in their percentage weight in the index, while double Bs have fallen, the opposite of high yield. So our high yield double Bs have been increasing, in bank loans double Bs have been decreasing, and single Bs, particularly B minus, has been increasing at a sort of a problematic rate. This was happening up until last year, but now B minus, which is the riskiest, basically performing part of the market, I would say, is 25% of the market. So that means 25% of the market is just on the verge of going into triple C. Triple Cs on average default 20% of the time. So there's a lot of risk in triple Cs. So you have a lot of credit quality issues in the bank loan market. That's why it shows up having higher spreads on a relative basis. If you look at Ken's spread chart, it shows up closer to the top of the page, meaning it has relatively more cheapness than high yield.
Cheaper reason.
There's a reason for it. It's because it has substantially more risk. It's not just that there is lower ratings, but it's floating rate. So this rate pressure has hit them now. A high yield bond, borrower a triple C high yield borrower that borrowed at 6% in 2021, their coupon's still 6%. A bank loan issuer issued in the bank loan market with a triple C rating, that was around 6%. Now it's moved up to 13, 14%. So the borrowers in the bank loan market have already felt the stress. High yield hasn't. And so the riskiness in the bank loan market is present. They, because of rising rates, have almost no free cash flow, and their leverage has been ticking up, and that's where the default risk sits. Now, it just so happens that in a strong market, the private credit markets have been refinancing some of this problem away. So part of the story of 2023, going into the beginning of the year, people thought that the bank loan market was going to have a substantial amount of defaults because this is all floating rate debt, and that's going to cause problems for the bank loan market and the CLO market. And that didn't happen really in any material way. The default rate ticked up a little bit, 1% or so. I think that's largely because there's this private credit market out there that's been taking this tail risk away.
They raised a ton of money and they had to put it to work.
They raised a ton of money, they have to put it to work, and this floating rate trade has worked so far. And because there hasn't been a recession, and because default rates are benign, so far the private credit trade looks like it's working. And so they've taken a lot of the risk that would have materialized in the bank loan market out, and that's why the performance has been as good as it has been so far. So it's sort of a pick your poison kind of environment. How do I look at it? I think that if we look at high yield, I just talked about this quality, the single B index is around 9%. These are some of our favorite names. These are household brands. These are companies that can generate, and credits that can generate equity-like returns, 9-10% type of returns in credits that have a low probability of default. So if you take a 2-year look, compare how are these high-yield index names going to perform over the next 2 years versus the S&P, I'm going to put my money on high yield. I think that there's a much better chance that high yield outperforms the S&P over the next couple of years. But even if it matches, it's doing it with a lot less volatility. And people have to remember a 9% yielding bond, yield to worst, with a, let's call it average maturity of 6-7 years or so. Those bonds have to get paid. So you're going to achieve that 9% return, or you're going to have a default. The S&P, the stock market, could sit at a valuation for any period of time. There's no guarantee that that multiples expand and earnings expand and that you get that return. In credit, you're guaranteed that return unless there's a default. And so you have just a better probability of achieving that 9% return in high yield credit versus the stock market. Now, for people who have a little bit more volatility, flexibility, maybe a stronger stomach, I think that there's a great opportunity, as Ken mentioned, to get these double-digit returns, 15, 20% returns, investing in companies that may not make it. Now, just because a company defaults doesn't mean that your bond is impaired. depends where you are in the capital structure, depends what assets you're secured against. And so there's an opportunity in senior secured high yield bonds and bank loans that are first priority on assets, first priority on value, that can generate these high returns if you're willing to accept the risk of default, obviously risk of price erosion, the risk of spread volatility. There's no free lunch, but for investors who can
longer term time horizon,
have a longer term time horizon and can accept this volatility, there's a very interesting opportunity there as well.
Well, one sector that we've seen, active management really play out this year has been within commercial real estate, right? So we've seen a lot of dispersion, and we talked about at the beginning how very tough to generalize or just paint the CRE market with a broad brush. But I think it was the late spring or early summer of this year where it seemed like every day on Bloomberg there was another headline about either a borrower defaulting or a property value getting appraised lower. So Morris, as head of our CMBS team, you see a lot of transactions in that market. Can you talk a little bit about what you're seeing from a fundamental perspective in terms of what's going on with commercial real estate?
Yeah, you made the comment about late spring, late summer, every day there's been defaults. I would say it's still going on, at least in terms of the headlines. However, like from a market standpoint, you just look at fundamentals and you strip away office, because a lot of the headlines today have been in office, but fundamentals wise, like from an economy standpoint, you can ask the question: is the U.S. economy okay right now, and has it been? And I would say, schematically, I think looking around this room, we would say so far so good. It seems like there's going to be headwinds, and the same could be said about real estate fundamentals. So far so good relative to the retail side of the equation, relative to multifamily, relative to industrial, relative to hotels. And the likes. So, from a property standpoint itself, ex-office, at this juncture, to the extent that you have the right debt in place in terms of liabilities, and to the extent that you have the right type of property type, there's actually been decent performance for commercial. Now, high interest rate environment has been a strain, continues to be a strain, and we're not here to say that there's no risk there's not going to be valuation declines in commercial. I do believe that there's going to be on a wholesale sort of basis, just given the reset in terms of interest costs. But at the end of the day, just like companies, properties, if given enough time, as well as borrowers and owners of those buildings, if you have pricing power and you can increase your cash flow, you can grow your way out of this increase in debt costs. So hotels are a prime example where it was super negative during the pandemic, but they've swung back in a full-fledged manner, right? Where you're seeing leisure hospitality assets perform exceptionally well. There are assets such as self-storage where you've actually seen double-digit year-over-year growth, just given the influx in terms of migration of individuals going from state to state, as well as going from and the moving sort of dynamic that's going on. Apartments, some markets actually, also have seen the double-digit sort of year-over-year growth. So it's really dependent on market, really dependent on what type of property we're speaking with. But from a wholesale standpoint itself, the fundamentals have actually held up. I do think, looking into 2024, there likely are going to be economic headwinds as we're looking at it from a macro standpoint. My team and I are always discussing what's worse, this higher for longer rate environment where interest rates stay at this level and the Fed continues to add pressure in terms of increasing rates, or a recession. Careful what you ask for, but I do think recession, at least on the commercial real estate side, we've seen what higher rates means for commercial, but recession is actually probably on the margin better for commercial real estate, all things said. But that's how we're looking at fundamentals.
So fundamentals, to your point, so far so good, ex-office.
Yeah.
But we've seen a lot of movement, right, in terms of the CMBS market. So we talked about spreads widening. We talked about kind of the performance. So what's been driving some of that performance when you look at the investable universe for CMBS?
The difficulty in commercial real estate and in CMBS is what is the value of a building, and when interest costs are at 8 or 9 or 10% or 11%, when cap rates on buildings historically have been in the, depending on which property type you're talking about, in that 5 to 9% range. and as a investor, putting a value on a building in itself, it's just that much more difficult. And so, given the uncertainty regarding this, the market is, extrapolating. Well, if interest rates are at 9 or 8%, if borrowing costs are as such, then schematically, at least in the public markets, then cap rates should be wider than 8 or 9%. I don't think there's a right or wrong answer, but the public markets is very, very quick to move. CMBS specific as well, and so you're going to have to reprice, buildings based on what you're observing and extrapolating that as the new normal, even though it may not be, right? And so if you just reset everything that used to be a 6 cap rate to a 9 cap rate, clearly there is pretty significant value destruction to the tune of 30 or 40%. And so the public market was very, very quick to do this. You saw this in equities. We saw this in CMBS. Liquidity is also kind of have shrunk, have pulled back a little bit in the CMBS market because of the uncertainty surrounding this. Collectively as a group, we can sit here. It's really, really difficult for us to triangulate what's going to happen to that office building across the street. And until you can answer that question, I think you're gonna still have this market where you're stuck in limbo. So in the broader sense, spreads have moved accordingly. I think if you just look at the extent of the scale of the spread moves, triple Bs are wider than March of 2020. Single A's to some extent are similar to that 2020 level, and to varying degrees, double A's and triple A's as you kind of go up in the cap structure. You're seeing that type of move in terms of spreads, and we're using 2020 as a benchmark largely because that was the most recent stress in terms of what the market has gone through. And I think overall the market has done part of his job to reprice, just given the risk, potential risk that's in the market. So what comes of that is potential opportunities as well. As we're looking at the world, we're all looking at public versus private. We're talking private meaning a building, specifically trading. What the benefits of being in the public markets is you're buying these bonds that are backed by portfolios of loans. These loans are debt. You're not the equity, or you're not the owner of the building. The loans themselves inherently have subordination or protection. There's a loan and there's equity beneath you. So depending on where you are in the capital structure within the loan, the more higher rating you are, the more protection you have. For AAAs, by way of example, you can stomach a 70% decline in commercial real estate property value before you see a first dollar impairment. That's just one example of there are CMBS issues that provide that type of protection. So I think in totality, the public markets, because of some of the spread moves, particularly in the higher grade, when I say higher grade, AAAs to single A space, there's definitively some value to the extent that you spend the time and cull through that.
I mean, you have yields on high quality, shorter duration CMBS that are higher than cap rates people paid for multifamily a year ago, when stuff was trading like sub 4% cap rate, and you can buy a secure bond, right? And it's in fact the debt markets are so cheap that I talk to private equity real estate players that buy the equity, and they're looking at the debt.
Yeah, that's happening across the universe. That's exactly what private equity investors in corporate credit are doing. So the buyout shops that would normally go buy a company, now they're looking to buy the debt because it's the same kind
They're
of,
like, if they default, I get the company at a discount.
well, they were running models where the equity was generating a 10, 12% return. So the return opportunity is substantial. I think what we're seeing though is that individual security selection is very important. It's not a big beta trade where I'm just going to buy an asset class, whether we're talking about CMBS, corporate credit, wherever it might be, CLOs. It's about picking the right bond that has the right idiosyncratic attributes that set you up to win.
So credit pickers market. So Ken, maybe switching to residential, right? Morris talked about some of the pressures facing commercial, but at least on the residential side, it seems like home prices only go up, right? And you wrote an article in Barron's last year, I think it was the summer last year, that was titled "A Correction is More Likely Than a Catastrophe."
Yep.
And at the time, that was a relatively out of consensus view, right? We had home prices that were up believe 35, 40% from March of 2020, and a lot of people were calling for double-digit home price correction, but we really haven't seen that. So can you give some thoughts, as the head of the non-agency team, as what you're seeing in the residential market, kind of what's driving prices higher there?
Yeah, haters like to hate, right? So, people thought that home prices work like bonds, and then rates go up, home prices go down, and that's not the case. Most people just like to make statements like that because it gets headlines. We had a Channel 11 that we called Turning Bearish, and I think it got like 1,000 more clicks than if we had a more positive headline. But we obviously invest in mortgage credit. We've been doing it for a very long time. I've done it my entire career, as well as agencies. And it's all about the housing market, because if home prices go down, you're going to have worse, higher losses, more defaults, and that's definitely what happened during the global financial crisis. But if you had taken a step back and you had looked at the housing market, right even when COVID hit, relative to pre-GFC, we were just set up really differently. Let's just talk about supply demand first of all. We went into the GFC with 3.5 million existing homes for sale, and we were building about 1.5 million homes every year. And then all these people defaulted, and we had like 5 to 7 million foreclosures over like a 4 or 5 year period. Not every house hits the market at once. In some places, it takes way longer to go through foreclosure, get the house, get a broker, put it on the market. You won't believe it, but there's still some people that defaulted during the GFC that the house has still not been sold. They've just been like living in it for free.
I saw like articles in New Jersey,
Yeah.
right? New Jersey or Florida.
So put that together. So we had 3.5 million existing, plus 1.5 million new, plus 5 to 7 foreclosures over a 3, 4, 5 year period. We just had way too much supply, and rates fell into the GFC and after the GFC, and home prices didn't bottom and go up till like 2011, 12. Why? Because the supply overhang needed to get worked through, right? When we went into COVID, we had less than 1 million of existing homes available for sale. We were building about 1.5 million homes, and then we put everyone into forbearance programs, which means you're a borrower, you're the servicer. I call you, I say, hey Phil, I lost my job, I can't pay my mortgage, and you say, okay, well, you can go in this program for 12 to 18 months. We'll take your missed payments, we'll move them to the back of the loan. You'll get a job in 12 to 18 months, the economy will recover, and then you'll start paying again. And that is exactly what happened, that forbearance program. And we used to do it during like hurricanes and natural disasters. And we even came out when COVID hit saying they might do forbearance, because we saw that happen on some Puerto Rico loans we owned. And that really helped. So less supply, and then mortgage servicing programs like forbearance. We didn't have the technology and the servicing platforms that we have now when the GFC hit. Like the servicing universe, the people that collect the payments and deal with the foreclosures, it was non-existent, because there'd never been anything like that. And thanks to the GFC, the mortgage ecosystem is really able to deal with loss mitigation. I think there'll be very low losses even into a recession. So we like mortgage credit. It's more about what's the spread, what's the duration, when we think about it, right? Mm-hmm. And so we're constructive on it. We own it across all our portfolios, and as we saw on the chart, it's pretty cheap relative to history. And one of the places that has been hit the hardest is government guaranteed mortgage debt. And it's government guaranteed. And it's people just, the market has really disliked it. And the spreads are near decade-long wides. So as we look at the MBS market, in the top left, that is the spread on the mortgage, on current coupon mortgage bonds. So those are bonds made today by loans being originated today, which are really high coupons, 7.5% or so. And you can see that chart goes back to 09-ish, and we're basically near the wides. And as we saw on that the scatter plots chart earlier, it's been in the 90th percentile all year relative to its own history. So I've been meeting with investors and saying, hey, look, this is cheap, but it's probably going to stay cheap for a while. Why? Supply-demand headwinds. As Robert noted, the supply-demand technicals are a really powerful thing. It's funny, I was watching or listening to Bloomberg News. I usually listen to it at the gym in the morning, and there was some strategists talking about how like the treasury supply doesn't matter. And I'm just like, that guy's never traded a bond in his life,
Right.
Ever. Because if there's supply coming, just like today, there's a treasury auction, prices go down, people lower their bids. And so one of the things that's happened in the mortgage market is that the two largest buyers are gone. The Fed was one of the largest buyers of the last 10 years. They're not buying. they're not necessarily selling, but just them not buying is one big buyer out in the market. And the second buyer, banks, which were huge buyers during 2020 and 21, they're out too because the money's going to T-bills, right? People are leaving their savings deposits and going to T-bills. And the third buyer, us money managers, while we may not be losing money, we're not really getting money in. So we're kind of already long on the trade and just sitting there, hoping people sell T-bills one day and buy bond funds again, right? So that's pushed spreads wider. We've also had the FDIC take over Silicon Valley Bank and Signature Bank assets, and they were selling all year from when those banks went under. They sold about $100 billion every week, billions and billions available for sale. So it's no wonder that spreads had widened. So not only are they cheap relative to their own history, if you look on the chart in the top right, that's relative to corporates. I'm not here to hate on corporate bonds. I like corporate bonds. I think they've done really well this year. And as Robert pointed, the quality of corporate bonds is really good. But there's this big valuation difference where this is through the end of October. We put that chart together. Mortgages have done well the last couple of days. And versus corporates, it was 100th percentile over 10 years. Basically, it's never been this cheap relative to corporate bonds. Over 20 years, I can't see the number because my eyes are going bad as I go.
98.
98 on 20 years, and even 30 years, it's 93. And this is getting into the weeds, but when you go back 30 years, mortgages trade off treasuries, corporates trade off swaps, and swap spreads were really wide there, so that's not really apples to apples. But even if you don't even listen to that nonsense, it's still 93rd percentile. So go back 30 years, and it basically hasn't been this cheap. Now, there's reasons that mortgages sometimes trade cheap to corporates. It's because they could have a lot of prepayment risk. These new loans being made today with a 7.5 coupon, you got to believe every borrower has a broker on speed dial, and the second they see a lower mortgage rate, they're calling them to refinance. So they're going to have a lot of prepayment risk. So there's a reason spreads are wide. So if you look at the bottom chart, that shows you the average dollar price of the mortgage index. It's on average at a premium because loans get made over time, plus or minus 100 or 200 basis points. And those bonds trade kind of at or around par, usually at a premium. And in the worst years, it got down to about a $95 price. In the best years, it got up to about a $105 price. But the average price until very recently was very close to par or a slight premium, meaning there was always this prepayment risk in the marketplace. The index price got down to almost $80. $80. Why? Because so much of the mortgage universe is skewed to these really low coupon bonds backed by low coupon mortgages, because hopefully if you bought a house or you owned a house, you refied into a 3.5, 4% mortgage. And so now you've got almost no prepayment risk in the market. So the spread today is wide, but the risk is really low. So if you look at the bottom right, that is the risk of the mortgage universe. It's called convexity. It's usually negative. I taught a class at USC. This was probably their favorite thing that I taught them. That was a joke.
It's an exciting class.
They probably fell asleep while I was talking about this, but it is always negative. My entire career, the convexity has been negative, and now it's positive because prices on bonds are so low. So that current coupon spread is not representative of the entire mortgage universe. The lower the coupon on the bond, the lower the mortgage rate, less prepayment risk, tighter spread. It's just something we track to that's apples to apples through time. Mm-hmm. But you can put together a very high quality, obviously government guaranteed mortgage portfolio that has a very attractive spread, we think, relative to history, that has very low prepayment risk. It's just been really unloved by the marketplace. I'll throw out some stats because I just have them memorized. On a 5-year look back to the end of October, mortgages have underperformed corporate bonds by 190 basis points annualized, 5 years. 10 years, 155 basis points annualized. They've even underperformed treasuries, and it's not surprising. We manipulated their prices for over a decade with QE. And so when you go from manipulation of prices to removal of manipulation of prices, you're going to have these type of market dislocations, right? But after seeing such bad performance over the last 5-10 year period, in fixed income, mean reversion is a very powerful thing. Mm-hmm. It's highly unlikely to see that, not just in mortgages, to just see that broadly in fixed income. So everyone needs to just stop looking in the rearview mirror and look forward. The past is the past, it's over. The forward-looking returns will be good. It's just that we went up another 100 basis points in rates this year. This is very uncommon, right? So from here forward, even if we see a recession, I think, you're going to see pretty good bond returns. And like I just look at, for example, short credit. I think we can all agree we love short credit, right?
It's easy to love.
Because for most of our careers, the short-term rates have basically been zero. So even if spreads were wide, let's say 200 is wide for an investment-grade name, it didn't yield much. It yielded 2. Right. So you can't really get excited about it. That's why everyone went and bought stocks, because like 2 was close to the earnings yield on the S&P 500. There was no alternative. Now with the 2-year, when it's at, let's just call it 5%, and you can buy 200 spread over it, you pick the asset, a corporate credit name, a CMBS name, you're talking about 7 yield. I know the T-bill yield's 5.5, but a 7 yield. Let's say we go into a recession. Where do you think the spread goes? Just throw a number out. It's from 200. Where does it go?
It goes another 150 basis points.
Okay, so let's say spreads widen 150 basis points. Where is the 2-year going to be at 5?
No.
Or is the 2-year going to be at 3.5?
It's going to be at 3.5.
So the spread widens. The reference rate that you price off of drops, especially on the short end. That'll drop the most. It may not even yield 7 anymore.
That's why the risk of a zero return or a negative return is very low.
The risk of a negative return is really
odds
low.
are, even in a recession, you'll have a positive return. It just won't be high single digit. It might be mid single digit.
But the forward-looking returns are so good. So you just stop looking in the rearview mirror. I know it's tough because everyone just looks at returns and follows momentum. There is rarely momentum in fixed income. It's very simple. It's not like equities where the world is your oyster, right?
That works for you and against you, because when there's momentum, PE multiples can expand, but it requires the entire market to agree to expand multiples. The beauty of fixed income is we don't need anyone to agree about anything. You're going to get your coupon and you have a maturity, and unless in the case of agency mortgages, there's no default rate. So if you invest that correctly, you will achieve that return profile. In credit spread product, if you pick your credits correctly, you will also achieve that return profile. It's only in the parts where there's potential impairment where we're not so sure if you get that return profile. But for everything else, you should get that return that you're promised on day one. You don't need the market to agree on a PE multiple. That's the difference between stocks. So stocks can run to the moon when everyone feels great, but sometimes the market can just feel lousy for a while. So,
all right, so more similar to what we've seen transpire in the commercial real estate market, right, with different types of bonds, whether it's fixed rate conduit, single asset, single borrower, commercial real estate, CLOs, we've seen a similar dynamic take place in the asset-backed security market, right? It used to be just consumer loans, right, auto, credit card, student loans, but we've really seen it evolve into a much more diverse marketplace. So can you talk a little bit about what you've seen transpire in the ABS market?
Yeah, I mean, as we look over the past couple of years, and specifically the last 10 years, the market has evolved in the sense that there are now, data centers being securitized. There are contractual leases based on franchises, based on renewables, based on the energy sectors as well. So there's a plethora of alternative asset-backed hard collateral sectors that have been securitized, and those are all options as a manager. So the notion that asset-backed securities are primarily in the consumer side, which is collateralized by credit card receivables or auto receivables, that's incorrect. There's actually a brand new, fairly robust market with a lot of different options and unique options for investors. If you don't like commercial, you can look at asset-backed securities where there's different collateral types which can help diversify an investor's portfolio.
And we talk.
We should talk about how there's cross-asset opportunities. So asset-backed and CMBS could be financing options for corporate credit, and we've seen in certain situations where a specific credit is accessing these different markets.
I think airlines, right? In 2020,
airlines, the data centers. There's just corporate credit that has warehouses that could be in a CMBS facility. And if you have a view on the credit, you can express it and maybe get optimize yields and return profiles by investing in these different markets, which I think it's another facet of how you can generate differentiated returns in whether it's other parts of the securitized market playing off of the corporate credit market.
Yep. So as that opportunity set has expanded, I hear Andrew Sue, who's the head of our ABS team, he often talks about the structure of, is another benefit of ABS. So Ken, I think you mentioned earlier that economy, might slow down next year, right? We might see unemployment tick up. And in that scenario, right, and if slower economic growth does come to fruition, how do you expect to see the structure, potentially benefit ABS investors?
I mean, I think just look at asset security selection, going to the security selection world. If you think the consumer is slowing down and there's risk on the consumer side, absent of just looking at consumer ABS, there are different asset-backed securities that you can play. Mm-hmm. You can look at more durable cash flows, such as data centers, for context, which are a little more recession resilient. But even coming back to the ABS world, at least on the consumer side, structurally, a lot of these transactions, particularly at the senior portions of the capital structure, they're designed to be very, very well protected from any principal impairment. Some of these structures will actually benefit from defaults, just given how those securities are structured, meaning, if a interest coverage ratio or a default rate were to increase or trigger a structural feature underlying these transactions, the most senior portion of the capital structure actually pays down quicker. And so I think in this environment, these profiles, there's definitely some interesting profiles, and you can play. It comes down to security selection, similar to the other credit sectors we've been talking about, where if you feel there's a recession, you can play that card. If you feel we're higher for longer, there's also different ways to access this ABS market and use the ABS market to diversify a fixed income portfolio, and that's something that we're doing. We are very, very cognizant of having diversification, and this is just another large asset class that perhaps investors aren't as familiar with, but there's definitely significant amount of opportunities here.
It sounds like there are a lot of opportunities. In Ken, to sum up your monologue, we like residential credit, we like agency mortgages. Robert, I think we like parts of the corporate market, right? Morris, you were talking about opportunities in CMBS if you're very selective. But as investors, we know, there's risk, right? Robert, you mentioned a few times there's no such thing as a free lunch. So maybe we can just do a quick roundtable and want to get your thoughts on what you all think are the biggest risks, maybe to either the U.S. economy or just macro risk in general, and then specifically as it relates to your market. So Morris, maybe we can start with you. What do you think is the biggest risk to the U.S. economy in 2024, and then the biggest risk for CRE?
I think the biggest risk to the economy is the Fed continues to hike, and ultimately breaks the economy in a even more meaningful way. So like that to me is that, and then increase in terms of rate volatility. So we're stuck in limbo type of world where rates continue to move in a more volatile way. It just makes it that much more difficult. I do think you're going to run into this wall where, right now it's the commercial wall, but eventually if it stays higher for longer, maybe some of the CCC credits or at least in terms of default rates will probably go up in a meaningful way as well. So that to me is the risk.
Robert, what about you? Same questions.
Well, we're talking about fixed income, so we always worry about the downside scenario. I think we have to think about the risk that we don't go into recession. So there's a spectrum of outcomes. One of them is we don't go into recession, and that's, I think, a reason why I find corporate credit very interesting, particularly below investment grade, requires a strong economy, right? If we go into recession, corporate credit, particularly high yield, spreads are going to widen, defaults are going to pick up. My actual base case is that we are stuck in this kind of morass of higher inflation, higher rates, slower growth, and that we just sit here for a while. In that environment, defaults continue to rise in corporate credit. Dispersion increases amongst the different parts of the market. So areas that have a lot of credit risk continue to leak wider. The high quality probably continues to tighten as everyone hugs the highest quality assets, wherever those might be. But in that dispersion is incredible opportunity.
So you have higher rates. Robert, you talked about higher rates as a risk. Ken, your risk, but you can't use higher rates as an answer.
Well, look, there's always policy error, which is higher rates. There's always geopolitical risk that's out there. I don't know. I think the market got a little complacent, thinking that there's not going to be any recession. Just when we got this like higher for longer mantra, the data finally for a bond investor finally started turning over. So I think the that we have to, you still need to be careful that, rates are high, even if they go another 25 basis points, whatever, rates are high, and that is hitting pockets of the economy. It hit the housing market first. Home prices didn't go down, but housing activity is dead, right? And housing is a driver of the economy, because you buy a house, most people don't buy a new house, they buy an old house, and they want to go fix it up and, go buy new furniture, and that's gone, right? The commercial real estate market has grinded to a halt. If you have friends that are in the commercial real estate brokerage business, they're just yet again something bad happening for them. Like, just can't win.
Feast or famine type of.
And so I think that be patient. There's going to be a slowdown. We're seeing it in the jobs data finally. The 3-month 10-year inversion, which is Powell's favorite, that happened in October of last year. And I was telling investors, let's at least give it 12 months before we give up on the recession call or a growth slowdown call. And magically, 12 months later, finally at the end of October, we start getting some slower data. So doesn't mean doom and gloom that we're going to have some GFC thing, but it just means that slower growth, that is good for bonds. So I don't want to be negative Nancy bond manager, but slower growth, inflation's coming down. I think that's going to happen. I think that we're close to maybe the peak in the 10-year. You never want to say it's the peak, because then literally tomorrow we'll be at 525 on the 10-year. But I think the long-term rates, at least in the near term, will probably come down. They already have come down a lot as the economy slows. But then the bigger risk in the future, and Jeffrey talks about this a lot, is just the deficit. Like, we're just spending money like it's nobody's business, and it doesn't matter. So I think that's the long run risk. In the near term, growth's going to slow. I think bond yields will fall, and high quality fixed income can do well. But maybe after that, you never want to own the long bond ever again in your entire life.
And wrapping up here, last question, let's end with a hypothetical, right? So we all talked about the T-bill and chill trade, right? Buying the 6-month T-bill and just letting it mature and roll that into another 6-month T-bill. And that has worked out great this year, right? It's been one of the best trades. But, hypothetically speaking, let's say you all did buy the 6-month T-bill 5 months ago, and it matures next month in December. How are you all investing those proceeds ahead of 2024, given your outlooks? Ken, let's start with you.
I mean, it all depends on, what kind of investor you are, how old you are, right? And what your risk tolerance is. But I think you're supposed to spread some into intermediate term bonds. If you've been underweight, you need to get some duration in your portfolio. I think you got to move a little bit of it out the curve into kind of low short duration funds, 2 to 3 year. And that's, so you're not going all in on rates, and you're picking up a ton of yield, as Morris noted on the inversion, albeit the inversion is much less today than it was, 2 months ago. And then take some of that equity beta and go into some of these credit markets, and just know it's volatile, right? And, there's been this huge wave of private credit, private debt. They don't mark their books. They've had good returns because they don't mark their books. But they just don't look at that attractive to locking your money up. When treasuries yielded 1, corporate bonds yielded 2, and high yield was 4, and you could get 10 net in some direct lending thing, it made sense. But you can get 10 and even more without locking your money up, right? So I think if you're going to go into the deeper parts of the credit markets, you don't necessarily need to lock your money up in super high fee vehicles like that. And there's other ways to get exposure to it. And I think it'll do better than equities, as Robert noted.
So generally balanced portfolio. Robert, how about yourself?
I guess what I'd say from a high level, just to kind of extend what Ken was saying, is that traditional assets work now. A lot of these alternatives, whether it's private equity, private credit, other alternative assets, were solutions to a zero interest rate environment, to yield suppression. Now that we don't have that, traditional asset classes now work. Traditional fixed income, traditional equities. You don't have to come with an alternative because the base stuff works.
There is an alternative. Right before it was TINA.
Right.
Now there is an alternative.
I think it matters what your portfolio base is. So let's say you just take the standard 60-40. I think that with the cheapness of overall fixed income, everything we're talking about, and the issues in equities, I would say that you need to be, instead of 60-40, maybe the balance needs to shift a little bit. Maybe it's 50-50. You shift it a little bit. Other investors are going to have a balance different than 60-40. But I think whatever your risk exposure would be, I think tilting it towards these other areas of fixed income that we're talking about seems very attractive. The T-bill and chill, as those roll off, depending on your risk tolerance, you move into either longer duration And longer duration doesn't mean you go into a 30-year. Maybe you just move to a 2, 3, 4-year duration. You take a baby step out of a T-bill. And maybe you take some equity exposure or money that would have gone into the equity markets, and you take that T-bill and roll it into below investment grade credit. So a mix of that, I think, makes a lot of sense.
The potential to generate equity-like returns, but potentially protect more on the downside.
With a lot lower volatility, yeah.
And then Morris, ending, same question for you.
Yeah, I mean, I think to sum up, fixed income there's a lot of yield in fixed income and credit. And you can, whether it's high yield, whether it's asset-backed related securities, whether it's commercial, whether it's in residential. And yield, with a lot of yield actually protects the investors from a downside perspective as well. As a bond investor, we always look for what is the downside versus the upside. When we talk about convexity, we talk about yield per unit of duration. At the end of the day, there is significant relative value in fixed income. Yield fixes a lot of problems, and even if you go into a downturn, when you have a portfolio that's generating a yield of 6, 7, 8, 9, depending on your credit risk appetite, that's significant yield, and that's locked in. That is yield that you decide. If you're an investor, you're putting your dollar into this fund. If you have a duration of 5 and you lock in and your portfolio is yielding a 6 or 7, you're locking that in for the next 5 years, even if you don't do anything, right? And so I think that's a pretty powerful sort of notion today. I think it makes perfect sense to me if you're in the T-bill and chill trade to extend your duration a little bit. You should think about locking in some of this yield and for a longer time horizon. And I think now's even better time than last year, and much, much better time than in 2021.
Yeah, 2023, I remember coming into the year, I was reading a lot of sell-side reports, and a lot of them were titled 2023, the year of the yield.
They missed it by a year.
They missed it by a year, yeah. So 2024, the year of the yield. Yeah. Well, gentlemen, thank you all for being here today.
Thank you, Phil.
Really appreciate the conversation. Thank you all for tuning in. If you like what you saw today, you can view more content at doubleline.com, or please email us at info@doubleline.com. I hope you and your families have a great holiday season, and wish you a prosperous 2024. Thank you.